is all set to, release their numbers. They've released their numbers, but they're going to address the media at this point in time. So we'll just cut across to that in moments from now. I think they're going to start to speak now. Absolutely stable asset quality for HDFC Bank. No problems at all this time around. Solid loan growth coming in as well on the line, on expected lines. So let's cut across.
Earnings call. As usual, let me just walk you through some of the key financial parameters. You probably might have seen the press release already, but I'll try and highlight some of the numbers, and I'll be happy to take your questions thereafter. So for this quarter, if you look at total income growth, that's sort of gone from 18,862 to 21,560 crores. Net revenues have grown by 21.1%. to reach 12,501 crores. As you know, the largest component of net revenues tends to be net interest income, which is approximately 73% of net revenues. Net revenue growth was again at 21.5% and went from 7,450 crores to 9,055 crores. This NII growth was driven by average asset growth of a little over 19% and a net interest margin which bounced back quite sharply to a core NIM of 4.3%. Other income, which constitutes 27.6% of net revenues, grew by 20.3% to touch 2,865 crores. The largest component of other income tends to be fees and commissions, which grew by 16% from 2,172 crores in the corresponding quarter of last year to 2,523 crores. Moving on to operating expenses. Operating expenses were, in terms of growth, were held back, and with a growth of 13.9%, which touched 5,220 crores in terms of operating expenses. The cost to income ratio for the quarter was 42.4% as against 44.9% for the corresponding quarter of last year. Provisions and contingencies were up. They were at 1,262 crores as against 662 crores. So that was an increase which I'm sure all of you would have noted. So let me spend a minute on that. So if you look at it, whether you look at it year on year or you look at it on a sequential quarter basis, provisions were up about 550 crores, for instance, on a sequential basis. Of that 550 crores of increase in provisions sequentially, 270 crores were on account of general provisions for standard assets. And that reflected the strong almost 60,000 crore increase in advances during this quarter. So again, of the 550 growth sequentially in provisions, 270, which is pretty much half, came from the increase in general provisions. Of the balance, again, about 100 crores is the spillover impact of what would have been provisions on the NPLs which got spilt over from the previous quarter into this quarter because of the dispensation relating to demonetization which was permitted by the RBI in the last quarter. And therefore, when you look at it on a comparative basis between there is a sequential quarter, the December quarter and this quarter, if you sort of push that back 100, then of that balance 250, 270 crores, actually the gap narrows to about 70, 80 crores, which is about a 15% increase. So was there a 15% net adjusted increase on a sequential basis? Yes, but it gets exaggerated by a large increase in the general provisions, which is a result of the loan growth, and the fact that there was this dispensation for small loans less than 1 crore, which meant that about 240 crores of NPLs which did not get recognized spilled over into this quarter, and there would have been about 100 crore provisioning relating to that. That 15% residual growth did come from a couple of products, including SLI, Agri, which were clearly segments that were impacted by the demonetization period, and a little bit from some of the other retail and corporate businesses. So I sort of spent some time there because I guess that's the one number which I know a lot of you had questions about, so I thought I'll preempt some of that. Of course, post provisions, after providing for taxation, the effective tax rate also is a little higher, but nonetheless, post taxation, the net profit for the quarter was 3,990 crores, which increased 18.3% over the corresponding quarter of last year. For the full year, again, our net profit, strangely enough, has increased exactly at 18.3%. So our full year net profit was at 14,550 crores. This is for the, as against last year's growth. For the full year, again, NIM was at 4.3, and our cost-to-income ratio for the full year was about 44.5%. Moving on to the balance sheet figures, again, we've seen rather robust growth, especially when you view it in relation to what the industry has been experiencing of late. Our total balance sheet size touched 8,63,000 crores. This is up from 7,40,000 crores last year, as of March 2016. Total deposit growth was at 17.8%. We touched 6,43,000 crores, and within that, both current and savings accounts grew by about 30% each. There is, of course, some hangover of the spurt that had been seen in the previous quarter post as a result of the demonetization, but nonetheless, the year-on-year growth in both current accounts and savings accounts remained rather strong at a little over 30%. Fixed deposit growth was at 7.9% for a couple of reasons. One, of course, as you know, in the December quarter, we had a runoff of a little over $3 billion of FCNR, which is part of the fixed deposits. And in this quarter, given the strong liquidity as a result of the strong CASA growth, clearly we had moderated the fixed deposit growth in the March quarter. As we get into this quarter and as we get into this financial year, we of course will be back to normalizing our growth on fixed deposits as well. But certainly last year, with the CASA deposits growing at a little over 30% and fixed deposit growth in single digits, the CASA ratio as of March 31st actually touched almost 48%. Moving on to advances, again, in an environment where the industry advances year-on-year grew by a little over 5%, I think 5.1%. Our total advances growth was at 19.4%. Our domestic advances growth, because again, if you remember the adjustment of the FCNR linked lending in our overseas books, which ran off in the December quarter. So if you look at the year-on-year growth in the domestic loan book, that was even stronger at 23.7%. And if you look at it, the way we run the business rather than the Basel classification, which is a function of size and so on, as businesses, both our wholesale and retail businesses, especially in this quarter, grew at almost equal amounts. So the total growth in the loan book was roughly 60,000 crores, and we saw almost 30,000 crore each coming from both the wholesale and the retail loan books. The mix, therefore, as of the end of the year between retail and wholesale is about 53 and 47%, 53 being retail and 47 being the wholesale book. Obviously, capital adequacy came off a little with the strong growth in the loan book, and total cap add was at 14.6%, of which Tier 1 was at 12.8%. So still very healthy, but reflecting the growth in the risk assets, which was the loan book. The Board of Directors have recommended a dividend of rupees 11 per share. This is on each share of 2 rupees, as against 9 rupees 50 paisa per share, which was declared last year. Our network, again, if you might recall, in the first 9 months of the year, we had somewhat limited amounts of expansion in the branch network, but we closed the year with just under a couple of hundred new branches, and we therefore closed the year with 4,715 branches in 2,657 cities, and the mix is now 52-48 between semi-urban and rural and our urban and metropolitan branches. Asset quality certainly in percentage terms was flat at 1.05%, which was where we were in December as well. And I did touch upon that when I was talking about provisions, so I won't sort of elaborate on that right now. Including, of course, our two subsidiaries, both of which continue to do rather well. On a consolidated basis, our net profit for the year was 15,253 crores, which was up 19.2% over the consolidated profits of last year. So maybe I take a pause there and take some of your questions.
So, on the domestic loans front, you've done fabulously, and you said the industry was only growing at 5%. While retail has been good for you, wholesale has also been very good this quarter. Does it does it continue to come from the working capital side? And two, should we assume the blip that we've seen in the last couple of quarters of slow loan growth, demonetization-related measures, is that well behind, or is this an exceptional quarter for you?
Well, one, I think you're right that on the wholesale side, much of the increase, I would say a very substantial portion of the increase did come from working capital and short-term loans. We've said this in the past that we haven't quite seen the growth in the capex-related demand as yet, and which is no surprise if you look at the system growth as well. So obviously we've been gaining market share on the wholesale side in working capital, trade finance, short-term loans, and we expect to continue to do that. Given our digital initiatives on the wholesale side as well, I think our ability to provide significantly quicker turnaround times, better servicing, better service quality in terms of transaction processing, all of these with of course a focused sales effort has been enabling us to get new customers as well as increasing penetration on existing customers. So I don't have a number to guide you to since we've never had that in the past, but we, I think, remain extremely well positioned in both the wholesale and our retail businesses to continue to outpace the system.
But would you say this was an exceptional quarter, much better than what you have done in the last few quarters at least of the past?
Well, this was certainly a quarter which was much stronger than the last couple of quarters in terms of both the percentage and the absolute amounts of growth. Some of it, of course, could have been also the fact that in the last quarter, as a result of the demonetization, we also had some repayments and prepayments in one or two segments, which was again drawn down again. But we saw a lot of the large public and private sector corporates borrowing for their working capital requirements, and we clearly got a reasonable share of that pie as it was being
jump in provisions in this quarter, while the bulk of it has come from demonetization related, the 90 days, 60 to 90 days relaxation RBI given. How soon do you expect that recovery to happen, when you can reverse these provisions?
No, what I was mentioning is, first of all, a substantial portion of it has actually come 280 crores, as I mentioned, on a total basis, and sequentially an increase of almost 270 is from general provisions, which is really linked to, roughly 40 basis points odd on the growth of 60,000 crores. But the clarification I made in relation to the demonetization was simply that because there was a 60 to 90 day dispensation given to customers with working capital or loans less than 1 crore in the previous quarter, loans which would have turned non-performing in the December quarter did not turn non-performing for another 60 to 90 days, and those therefore would have become NPL in this quarter. So when you look at it on a comparative basis, the provisions and the NPL formation in this quarter gets inflated a little, and to that extent you are comparing it with a base which is a little lower. That's the point I was making. Incidentally, some of these loans where the dispensation was available or made available last quarter would have therefore, with the dispensation, become NPLs. Some of them would have actually become NPLs in the next quarter. But we have actually not availed of that further dispensation because we believe that as far as our customers are concerned, things have largely normalized, and therefore in this quarter we have of course taken all NPLs which turn 90 days as well as those which did 90 plus 60 or 90 from the previous quarter. So there's a bit of a bunching up, if you might, or a double whammy, and certainly on a comparative basis, it tends to distort the increase.
But to answer that question, if you can, what is the indication as the recovery of these loans in terms of performance? You say it's seeing the loan level.
Well, first of all, of the total amounts that got the dispensation, to say that all of them were necessarily impacted by demonetization or not, we don't know. But so far, if I look at it on a quarter sequential basis, I would say about a third, between 25% to a third of them were what were recoveries, and the balance, would remain delinquent, turn NPA. Of course, you have a ongoing recovery process which continues.